Hi, this is Daniela Cambone, and welcome back to the Daniela Cambone Show here on Stansberry Research. Well, inflation is coming in red hot, hotter than expected. There's now concern the Fed is going to tighten even more. So what does this mean for the stock market? Please welcome to the show Joel Littman. He is the Chief Investment Strategist over at Altimetry. He's also the President and CEO of Valens Research. And he called the 2008 and 2020 stock drops. So where does he see the market headed next? Joel, always good to see you, and welcome to my show here.
Danny, great to be here. Thanks for letting me join you.
I just want to get your general consensus here on where you think the S&P specifically is headed next.
You know, you mentioned 2008, 2020. In early 2008, one of the reasons that we were so bearish on the market was because we're looking at the entire balance sheet of corporate financials, meaning we're looking at credit and equity, and it was screaming, when the market was only down 12%, it was screaming for a giant bear market. Meanwhile, at the bottom of 2020, corporate credit was so strong, corporate credit in the United States was so strong that that's why we were screaming that this is going to be, one of the best buying opportunities. And we reiterated that in March of 2020, and April and May. Right now, after the market's fallen off, give it 20%, we still see much more like 2020, not like 2008, meaning the bottom of 2020, that this is still an incredibly interesting market. It's a pullback in an otherwise bull market. We don't see the signals that say a big bear market is coming. And if anything, it might be a choppy 2 or 3 quarters, but we'd be dollar cost averaging in over that time frame.
I mean, Joel, you see the headlines like Bank of America saying, folks, the bottom is still not in for the S&P for this year. So when you see these type of headlines, what are you thinking?
Well, Danny, I made a career of making fun and discrediting Wall Street at every step of the way over the last 20 plus years. And this is another one where I just say, I don't know what data they're looking at. The data, I know the data isn't as solid. They're not looking at corporate credit. A lot of equity people only look at equities. They're not looking across the balance sheet, and they don't see the underpinnings over the couple hundred years of market cycle research that bear into it. And so, they look at things like inflation and they compare it to the 70s, but they don't realize what really drove 70s stagflation, which a lot of these analysts have been comparing it to, was super high taxes. Marginal tax rates in the 1970s were like 70%. That plus inflation is deadly. We don't have that right now. In fact, with the tax cuts that we saw over the last 3 to 5 years, we actually have the capacity to be able to handle inflation because taxes are much lower. And that tax and inflation combo as what created stagflation is something you never hear from the media and from most of Wall Street. They just don't talk about it.
So Joel, but what's going on? Why are we not able to pull back the inflation here? What else needs to happen then?
What we're seeing is again, there's bad inflation, and bad inflation is currency devaluation. So if the dollar was collapsing, right, over the last couple of years, that would concern us. But if the dollar were collapsing, why was gold down, 5% last year? Silver was down 11%. Palladium was down 22% last year. This is not a currency devaluation issue. It's a inflation driven by supply chain not being enough to fulfill the demand. And demand-driven inflation is, look, it's not great, but it's not the deadly thing to an economy the way currency devaluation inflation is. And so, people talk about inflation, they say it's rising prices. That's sort of like explaining a hurricane and saying it's falling trees. You have to understand why the inflation is happening.
Right, or Joel, they'll say it's really a cause of a money supply and just too much money having been pumped into the system for years and years.
I just don't think that's the case. You can look at money supply levels, but you have to look at money velocity also. And when you look at money velocity, right, meaning the amount of the money supply that's being used and reused and reloaned and reloaned and reloaned out over and over again, it just isn't happening the way it has been in the past. And so it's a concern when you see money supply there. But in fact, we would say that the money supply increases are offsetting the fall in money velocity. And it would concern me if money velocity was also increasing on this money supply, but that just isn't the case. And that's why we don't see currency devaluation. And that's why you can argue this is demand-driven inflation, which can be worked out as the supply chain fixes itself, and it has been. It's been doing a wonderful job. It's going to take time.
When you say take time, is it a question you think of, 5 years, a decade? How long?
It depends on the areas, but we'd say it's quarters more than it is years. And so maybe not by the end of this year, but into 2023, where we're still very, very bullish on what could happen. Who knows? It's 3-4 quarters away a year from now. But we think it'd be choppy we'd still be dollar cost averaging into the market. This is a hiccup. It's a big hiccup. But the market being down 20% after it ran up 75 is not the same thing as a flat market that's down 20%, right? It's a big correction, but it's still a correction in otherwise unbelievably strong fundamentals for the United States, for U.S. economy and U.S. corporate.
And I want to get back to that point and really hone in on it. But first, if we could just take a step back, because
Yes.
looking at your track record, you've made phenomenal calls. Your long-term projections are just, spot on. So tell us a little bit about the system that you've developed, altimetry, and how it can really hit these bullseyes, basically.
So the basic fundamental of this is that Wall Street, the financial media, they all use as reported financial statements. This is GAAP, generally accepted accounting principles, and they don't focus enough on the depth of the accounting and realize that the numbers are nonsense. Warren Buffett, in I think every one of his shareholder letters over the last 10 years, has slammed GAAP accounting, saying it doesn't make sense. And not just him, but you can look at all of the value, the Ben Graham followers of the last 20, 30 years, from Seth Klarman to Marty Whitman to Mitch Julis, will say you can't trust GAAP accounting. You can't trust GAAP accounting. And yet, what do you hear about all day long on CNBC, by Jim Cramer, by whoever else? It's just GAAP accounting, GAAP earnings. So what we built, and it took us 20-something years to build this, is a database that says we want to look at the real cash operating numbers of a company, the real cash investments, how a company is truly being financed, from the balance sheet to the income statement to every one of the 200 pages of notes in the financials, to get to the true economic earnings number. And when we do that, we get a totally different picture of corporate credit than you'd see from any of the credit agencies, and a totally different understanding of market valuations than any of the mainstream financial media would ever talk about. They just don't have the data. And if you don't take the time to do that, it's like, they're garbage in, garbage out. You look at bad data, you come up with bad conclusions.
Okay, so the interesting part about the latest, report that you have out, Perfect Stock 2022, is it's basically you meeting with Mark Chaikin of Power Gauge, a completely different system, more short-term view. Is that correct to say? So it's basically
Yes.
the meeting of the best of both worlds?
Yeah, Chaikin is a titan of the industry, and he's been on Wall Street for many, many, many years, while I've been slamming Wall Street for its problems. And you can say we put our differences aside, because what he was able to do is build a very good shorter-term timing mechanism. What's happening in sectors and what have you, where we're very much a bottom-up, fundamental, and then top-down together to say, here are the stocks we like given the themes and the macro themes. So while we're very, very fundamental, I think Chaikin has been fantastic with the technicals. When you put the two together, and we started back testing our research going back, over a decade, and saying, what would our numbers have said together if we took our numbers and used his timing, or used his timing only on our best fundamentals? You end up with this amazing perfect stock portfolio that's quite interesting, and that's what we've been launching together.
Okay, and I know if you watch, the report, you'll talk about that. But can you speak to some sectors that you're specifically liking or see the potential in right now, Joel?
Yeah, there's three big themes we're seeing in the U.S. corporates that are just amazing. One is there is a shale renaissance going on. There was a shale revolution that went into the 2013, 14, 15, 16, and then it pretty much died out. Companies overspent. There were a bunch of bankruptcies. Wells that just weren't dug correctly, if you will. And people have called on the oil and gas industry because of it in the United States being dead, quote unquote. They even said, "Drill, baby, drill is gone." Well, what we're seeing is a very smart and efficient way of doing that, and that theme is going to play out, and a lot of our best stock picks are coming from that one theme, in particular, the shale renaissance. Another one is the supply chain supercycle that we talked about earlier, that we see industrials with the demand that's increasing around the world for all kinds of things, and the U.S. being one of the best suppliers for that demand. It's almost like post-World War II, where the world had been devastated, there's wars going on, everything else had been going on, and the U.S. could supply the world. We're seeing the supply chain supercycle, another area for industrials and other companies to be able to supply the demand that inflation is representing. Because again, it's not inflation from currency devaluation, it's inflation from demand. Why wouldn't American companies want to supply that? And that's what we're seeing them do and motivate to. It's a wonderful theme for us.
Well, I'm excited to talk more about this, because I find your perspective completely different than a lot of experts that have come on this show saying, it's the end of America, don't invest in the U.S., all eyes on China, China's going to take over the world. But, I know in our conversations offline, you're saying, no way, you're super bullish the US. So give me your thesis, Joel.
All due respect, it's bad data, right? If you don't have cleanup data, so we're the thing we mentioned earlier that we're cleaning up the data, the gap accounting. We're doing this for Chinese accounting standards, for European accounting standards, for IFRS. We go back in time. We do it for international accounting standards. So we understand over the last 30, 40, 50 years what's really been going on with corporations. And this theme that people are talking about, where they say, China is going to overtake the United States in the next 5, 10 years, is a pipe dream. It's not going to happen. The numbers just aren't there. Now, what they keep talking about is GDP. Well, countries don't function on GDP. They function on taxes. This is, again, my expertise as a CPA and the lack of accounting expertise that unfortunately is in the world and with a lot of these macro strategies. When you look at the accounting from this standpoint, the U.S. taxation right now, the U.S.'s ability to raise taxes, to pay debts, to pay for national defense, to pay for whatever, social services, what have you, has been climbing massively on a lower tax rate. So on a lower tax burden, because of the profits of companies and the incomes of people in the United States, the U.S. is collecting at tax levels that are double and are soon to be triple what China collects. Right? And the direction is that China, because of the credit crisis it's going through, which, by the way, didn't start in the pandemic. It started in like 2016, 2017. The pandemic made it worse. But don't let people blame China's problems on the pandemic. There's been a credit crisis building there over the last several years that's worse than what the U.S. or Europe experienced in 2008. Worse than the Great Recession. If anything, it's closer to credit thing like the Great Depression, but in China. It's very, very, very bad, and it bears out in the numbers. So what we're seeing is China on the downfall, and unfortunately, because I don't want anything bad to happen to China, but the facts are facts. They're not able to collect the cash. Their GDP may be increasing, but corporate earnings and household incomes are not. And they're not able to tax it, and they're already taxing at such a high burden. The absolute dollars of taxes are falling while the uses are rising. When you look at that from a government standpoint, that means the U.S. can continue to fund whatever it decides to include national defense at levels that that no one even understands, can even fathom.
Let me ask you this, Joel, because for the folks at home, specifically those living in the U.S., they're going to say, fantastic news for us, Joel, thank you. But if we look around right now, we might not be feeling that. When do we get to start reaping those benefits?
Well, that's an issue. So we need the supply chain super cycle. It's going to need a few quarters to fix itself. The shale renaissance, right, in oil and gas in the United States is going to take a few quarters to a year plus to fix itself. But the market tends to move ahead. So while we think there's going to be choppy quarters ahead, we're talking about the next 2 to 3 decades of U.S. super economic dominance over the rest of the world, and the numbers bear themselves out. I mean, it's when you're using uniform numbers cleaned up across the world, it's so obvious what you see. Corporate America right now is generating more economic earnings, economic profit, than all the rest of the companies of the world combined. Right? To say China's number 2 and the U.S. is number 1 is such an overstatement of China's strength. Yes, China is probably number 1 of a number of countries, but add all the countries together with China, and it still doesn't even come to a third of U.S. corporate America earnings. It's unbelievable how strong these fundamentals are. And U.S. corporate credit is unbelievably strong, even with rising interest rates. Right? Rising interest rates is not a problem. High interest rates are a problem. So even if the Fed raises another 75 basis points, and frankly, even another 75 after that, it's still 60, 50-year low interest rates. High rates are a problem, not rising.
Do you think that they'll revert back to a point and start QE again?
That
they'll have
it remains to be seen. I think they have the ability to do it if they need, once they fix. But the Fed, one of their biggest issues is the concerns is full employment, and U.S. for the most part has very, very, very strong employment right now. So they have the ability to raise rates a bit, knowing that by raising rates to stem inflation, to cool off, I think, this pandemic rebound, right, that we've had in growth, that we'd be able to settle things a bit, calm things down. I don't think that's terrible. I think the Fed has room to move on that. And should things get strong again, have room to use QE if they have to. But I'm not using those words right now. If anything, we'd see even increased interest rates, a stronger U.S. dollar, and the Fed's ability to fight inflation with this very, very strong employment numbers to back it up.
Okay, I keep thinking of more and more questions for you, Joel. Okay, wait, two things. I'm getting excited. The shale renaissance that you speak of, will it happen regardless of who's in power? I mean, my question is it tied to politics, though? I mean, could it be slowed down or deterred depending on which party is in power?
Yeah, I think so. I think, though, that as long as we have more or less a gridlocked Congress and what have you, and it doesn't sweep strongly one way or the other, you tend to have an ability for corporations to move, to invest. The bigger problem is when rules and regulations sweep so far one way or the other direction on a pendulum that it's hard for companies to plan, because they're like, I'm not sure if I can plan for what could happen in the next year or two or three. But as long as we have some amount of gridlock, which I'd argue that's sort of what you're seeing right now, and we'll see what happens, come this fall. But if it maintains at some level so that you can't just have sweeping regulations one way or another, it allows companies to say, all right, good, I'm willing to invest. I'm willing to invest in the supply chain. I'm willing to invest in the shale renaissance. And that, bodes very, very, very well for the U.S. economy and for Americans in general.
And just quickly, you mentioned the U.S. dollar. I'm just curious to get your thoughts. I know you're bullish America long term, but let's look at what's happening in the USD here. It's slowed down a bit, so folks are now wondering, is this it for the U.S. dollar? Do you think it's just the best house on a bad block? I mean, what are your thoughts on the USD?
Well, so let me say in a big picture level, the idea that the U.S. dollar will not be the global reserve currency is crazy talk. It's silly to think that the U.S. dollar. So what you're looking at, the U.S. stock market right now is bigger than the rest of the world combined, right? The rest of the world's companies, U.S. corporate earnings. So if you want to get dividends and you want to get a return or capital gains, bigger than the rest of the world combined. If you want to get a decent rate on a AAA rated bond, you go to U.S. Treasuries. You can't go to other countries. You're going to get a negative rate, right? In some cases, or a super negative real rate. Unlike in the U.S., where you're actually getting a pretty generous, 2 to 3% on a treasury. And so if you think that the world's sovereign funds, the world's endowments, the world's money, all the wealthy people in the world are forced to invest in U.S. stocks and U.S. bonds, to rely on the U.S. banking system and the SWIFT system around the world, the idea that the U.S. dollar can't be the reserve currency is just kind of crazy, because you'll constantly be transferring it back into the majority of the world's capital, which is domiciled in the United States, right? Which you see both from corporate earnings and market cap. So at a big picture level in the dollar talk, I have to mention that right away. And I know other people disagree.
Yes, certainly a lot of folks that have come on this show would definitely disagree, saying, well, Joel, we saw with the Russian invasion of Ukraine and then the sanctions that countries like Russia are finding solutions outside of the US dollar. And we're going to see other countries following suit, the BRICS. So wouldn't that lead to the demise of, not always thinking that it's just going to be the USD as the global reserve currency?
So here, if you just think about the MSCI indices, right?
Yeah.
Of MSCI developed markets of, 30 countries, only one of them is Hong Kong. The rest of the developed markets are all US dollar based, right? And I'm talking about the rest of the world. Now, if I start saying, what if we take Russia? Russia's a very small economy, right? Russia's taxes in a year are only $350 billion a year versus the United States, which collects $4.8 trillion a year. So think about the relative strength of the governments when you think about that, right? And from the standpoint, not just of GDP, but are there corporate profits in Russia with which to be taxed, just not like in the United States. So when you start looking at global power and global economic power around the world, and you look at China or Russia or any of these countries, you just don't see the money. It's not there. And so when you look at the developed world, meaning the countries with the most liquidity, the most developed markets, the most capital formation and what have you, right? Of all of them, the only thing you're really losing is Hong Kong. And the rest of it is all US centric. Because some people have talked about, they say there's an end of globalization. No, what we're seeing is a re-globalization around the United States system, the United States laws, United States contracts. Let me throw in the Fifth Amendment. And I'm talking about the Fifth Amendment, the right to not self-incriminate. I'm talking about the Fifth Amendment that says the government can't take your stuff, right? Under the Fifth Amendment, the government can take your stuff. Is that the case in other countries? And so when you see the developed world that respects, right, private property and the right for people to keep their stuff and not let the government just come and take it, you see a developed world with the dollar around it, right? It's crazy to kind of think that whatever Russia and whatever China does, and throw in a few other countries, right? Cuba, I don't know, whoever, Iran, it's just not enough to offset, right, the value, right, of what goes on in the rest of the world. Yeah, it just isn't enough. Yeah.
Okay, I need to bring you back another segment to talk more about that.
Sure.
But bringing it back to Perfect Stock, just tell us a little bit of what we can expect from it, where we can get more info, Joel.
I mean, I think it's wonderful. So what Chaikin and I and our teams have done together is look at the system he's been building over 10 plus years and the system we've been building for 20 plus years and said, what if we took the best output of our fundamentals? Because he's not using uniform accounting. He's still using GAAP numbers for his fundamentals, but he's using all kinds of amazing timing indicators that we don't use. And so you put together and you find, generally speaking, we're still looking at the same stocks, but the buy and sell signal windows that he allows us to see when we put them together gives us a better timing on it, and we see better results across the board. We look at our ideas together. So we basically take our systems, and every month we say, here are the best ideas of both the short-term timing nature, but also have really, really strong fundamentals. Our worry is that we wouldn't see an overlap. But we saw 130 something, what we call perfect stocks that line up in both of our systems, and the performance is fantastic. And what we're seeing is, right now is that we'll see another 10 to 20 stocks in the next year and a half that ought to do very, very well using the system together.
All right. Well, I urge everyone to check it out. Perfectstock2022.com. Again, that's perfectstock2022.com. Joel, I loved our conversation. Come back soon. It was an absolute pleasure.
Love it. Love it. Thank you.
And thank you all for watching. We'll have more incredible content coming your way here on the Daniela Cambone Show. So be sure to stay tuned to Stansberry Research. And don't forget to sign up at danielacambone.com so you can stay on top of all these fantastic interviews. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.